There are three tests standing between you and the ability to use your rental real estate losses against your wages or other income. Not one, not two, but three. Pass all three, and those losses may be able to offset your wages, your business income, even your spouse's paycheck. Fail just one of those, and a six-figure tax deduction could sit frozen for years on your tax return. And here's the part most investors don't realize. You can qualify as a real estate professional and still lose the deduction. Said that again. You can qualify as a real estate professional and still lose the deduction. A lot of people don't even realize that. You can make the grouping election and still lose your deduction. You can even work the hours to qualify for material participation and still lose because you cannot prove them. There are three things you have to hit. But stay with me, because I'm also going to show you a type of real estate investor who may be able to skip the real estate professional test entirely and still use real estate losses against their other type of income, like their wages. So here's the roadmap we're going to go over. First, I'll show you the two-pronged test that determines whether you're a real estate professional at all. That's going to be test number one. Pass this test and you're a real estate professional. But that is only one of three tests. You still have to hit these others to make the losses non-passive so that they offset things like your W-2 income and your spouse's wages. Second, I'll show you why becoming a real estate professional does not make your rental losses deductible and what you need to do to unlock those losses as non-passive. Third, I'll show you the election that lets multiple properties work together so you can unlock even more losses. Then I'm going to show you why short-term rentals may play by completely different rules, how cost segregations can create massive deductions that still get trapped, and why some states like California may ignore the federal rules completely. Finally, I'm going to show you the documentation mistake that causes taxpayers who may have legitimately qualified to lose anyway. I'm Toby Mathis, I'm a tax attorney, and let's start with test number one. Real estate is automatically treated as passive under the tax code. The regulations call it per se passive, and that means your rental losses generally only offset other passive income, which is rental income or things like a business that you do not materially participate in. They do not automatically go over and offset things like your W-2 wages. They don't automatically offset things like, hey, the profits from your medical practice or your law firm or your consulting company or whatever your business might be, whatever that active business, it doesn't automatically offset that stuff. And it does not automatically offset your spouse's paycheck. No, Congress created an exception to the passive loss rules for certain people who are actively engaged in real estate, and it's called real estate professional status. I'm just going to call it rep status, real estate professional. But the name is misleading. It's not a job title and it's not a license. And it's not something that you check on a tax return because you have like 3 rentals and you watch a lot of HGTV. No, it's a tax status that must be earned every year you want to escape the passive loss rules. They're called PALs if you ever talk to an accountant on rental real estate. So let me give you an example. Let's say that Joe makes $300,000 as an engineer, but he also has real estate on the side. And he has a good accountant, he watches this channel, and he knows how to create big losses from cost segregation and bonus depreciation. So he has $100,000 in passive losses from those using the cost segregation and bonus depreciation. It creates paper losses. We'll discuss those later. So you'd think he has $300,000 that he made as an engineer, but he has $100,000 in losses from his real estate, so he should only have to pay tax on $200,000, right? Wrong. The real estate losses are passive. They will not reduce Joe's income as an engineer unless Joe can qualify as a real estate professional, unless Joe can meet these 3 tests. But how do you qualify as a real estate professional? Let's just go over this. To qualify as a real estate professional, you generally need to satisfy 2 requirements, I'll call them prongs, during the tax year. First, prong number 1, 750 hours. It's called the 750-hour test. You must perform more than 750 hours of services in a real estate, property, trade, or business in which you materially participate. In other words, you have to actively be in that business. Second, more than half of your professional services or personal services you must perform in trades or businesses during the year from those real estate trades or businesses. So it has to be more than 50% of your personal services that are in the real estate trades. You must satisfy both. This is not a 750-hour test. It's both. The second requirement is usually what knocks people out, by the way, that have a full-time job. So let's just say Joe, he works full-time. He works 2,000 hours as an engineer, but he also spends 800 hours working on real estate. Well, he cleared that 750 hours, but he's not a real estate professional. Why not? Because 800 hours is not more than half of his total time. So to clear the more than half test, the more than 50% test, Joe generally needs to spend more time on real estate than he spends on his engineering job. That means he's going to have more than 2,000 hours in real estate on top of his full-time, employment. That's brutal math. No court's going to buy it. And this is why real estate professional status is generally more realistic for someone who's a full-time real estate investor, or if you have a spouse who does not have a full-time or a super demanding outside job. I'll go over that in a second. Real property trades or businesses, what do they even include? It's a lot more than just owning rentals, and it has nothing to do with your properties. It's, I am a realtor, I am a developer, I work in construction, I work in acquisition of real estate, the conversion of real estate, I fix up properties, rentals, the operations, the management of properties, the leasing, brokerage. All of those are real estate trades or businesses, and you combine them up to hit those 750 hours, and then you add them all up together and they have to be more than 50%. But stop right there. That does not mean every hour connected to real estate counts. The work must qualify, your participation must qualify, and you need to be able to prove what you actually did. Tax court cases are filled with people who claimed hundreds, even thousands of hours, but they couldn't back them up. In one case, the taxpayer had a full-time sales job and claimed he also spent more than half of his time working in real estate. He was full-time. The court just said, there's no way. He had 2,000 hours as a salesperson, and he had 2,001 hours in real estate. Yeah, they were like, no, I don't buy it. That's too many hours. There's no way. In another case, the taxpayer attempted to reconstruct their hours after the fact. They didn't keep actual time slips. And the judge just said, hey, that sounds like a ballpark guesstimate. Throw it out. And that is not the phrase you want to hear a judge using to describe your tax situation. Now compare that with taxpayers who could identify the work they actually performed. Hey, they did the bookkeeping, they did repairs, they did tenant screening, advertising, contracts, insurance, property inspections, contractor supervision. That is what credible participation looks like. And here's another rule people miss. If you work as an employee in someone else's real estate business, you're not an owner, those employee hours do not count towards the 750-hour test. You have to be more than 5% owner of the employer. So let's just go to Joe and Mary. Let's say Joe's married to Mary. Mary works 1,500 hours a year as an employee of a property management company, but owns none of it. Those hours aren't going to help her qualify. If she owns more than 5% of the company, you get a different result. Now those count towards rep status. So you can't simply say, I work in real estate, so my hours count. No, how you work and whether you own part of the business actually matters. Now, here's where married couples a lot of times get confused. For this test number 1, you do not combine the spouse's hours. You cannot take the husband's 400, Joe's 400 hours, and Mary's 400 hours and say, great, we have 800. It doesn't work that way. One spouse must personally qualify. They have to exceed 750 hours and the 1/2 requirement, more than 1/2 of their personal service time, by themselves. But if the couple files married filing jointly, you only need one spouse to qualify. So let's go back to Joe. Joe works full-time as an engineer. He's never going to qualify as a real estate professional. But Joe's wife, Mary, does not work outside the home. Mary manages the rentals. She coordinates the repairs. She screens tenants. She handles the bookkeeping. And she spends more than 750 hours in qualifying real estate businesses. And since she doesn't have anything else, more than half of Mary's working time is those activities. So Mary qualifies. And because they filed jointly, boom, now they may receive the benefit of her status. For test number 1, Joe does not need to qualify separately. And that is test 1. Congratulations, Joe and Mary. You are real estate professionals now. That's literally what it is. So can they now deduct the $100,000 in losses against their W-2 income? Remember, Joe makes $300K? Not yet. Passing test 1 does not automatically make the rental losses deductible. It only gets you past the first door, the first test. Real estate professional status removes the rule that automatically treats your rental activity as per se passive. It's no longer per se. So now we have to get to the second rule. You must still materially participate in the activity to produce a loss. You still must materially participate. This is no different than if you owned a pizza shop with your brother. And he works in the pizza shop. He cooks the pizzas. And you do nothing. You just own, you're a silent owner, you're 50-50. You would be passive. They treat that income that you make as passive income, which, by the way, could be offset with passive rental real estate. Now, some light bulbs might be going off in people why rich people tend to be passive owners. Your brother, however, he's materially participating. So his activity is no longer passive, but yours is. Same activity, still a pizza shop, but my activity and how I am participating in it dictates whether it's passive or non-passive for me. So material participation has to be cleared before you get to deduct losses as non-passive. See, these are two separate tests. Real estate professional status looks at your work across qualifying real estate businesses. And it doesn't have to be your properties. It's just, hey, are you in a real estate trader business? Do you own a construction company? Or do you own a property management? It doesn't have to be your properties. But material participation, this one looks at your specific involvement in your rental activity. Your rental activity. So you could be, hey, I'm up here and I have my own construction company, I'm a real estate professional. But then we have to look at your property specifically. And there's 7 different material participation tests. 7 of them. I'm not going to go through all 7 because investors really only have to focus on 3 of them. And those tests are really kind of simple. You participate more than 500 hours in the year. And by the way, this is 2 spouses. I'll go over that in a second. You get to combine your time for this on your real estate. Or the work that you are doing constitutes substantially all of the participation in the activity. So if you have rental real estate, you're doing everything. You don't have a property manager. You don't have people working on the properties. It's just you. Or test number 3 that's more likely is you and your spouse work more than 100 hours on your properties and nobody else, no other individual participates more than you do. So you have 100, let's say you have 110 hours and somebody else does 101 hours. You would qualify because you have more than 100 hours and it's more than anybody else. There's other tests that may apply in specific situations, but those 3 cover almost all of the conversations I have with real estate investors. Now here's the trap. This is what trips people up. You see the court cases on it and breaks your heart. Material participation is generally determined separately for each rental property you own, unless you make an election to treat all of your rental real estate interests as one activity. That's called grouping, and that is test number 3. It's called a grouping election. I'll get to it. So let's say Joe and Mary, they own 2 duplexes. Mary spends 300 hours working on the first one and 300 hours working on the second. That's 600 hours total. But without the election, they may be dealing with 2 separate 300-hour activities. You have to qualify per property. So Mary doesn't automatically satisfy the 500-hour test. Even though she worked 600 hours, she does not meet the 500-hour test per property. She might qualify in another test, maybe the 100 hours. Maybe she just does everything. She performs substantially all the work. Maybe nobody else spends more than she does, but you can't simply combine the hours because it's convenient. Same taxpayer, still Joe and Mary, same 600 hours, but man, that could be a completely different result depending on whether the activities are combined. Now here's a pattern interrupt because the spousal rule flips on this. For the 750-hour test, one spouse just has to qualify independently. Joe or Mary must qualify for this one. So I'll just put like independent. One spouse has to qualify. For the material participation, and even the grouping, it's joint. You get to combine their time. So here's how it works. Suppose Mary spends 350 hours managing duplexes. Suppose Joe, maybe he's the weekend guy, he's working a full-time job, but he goes out and does the repairs. Maybe he does, heck, a lot of the bookkeeping and contractor supervision, but he spends 200 hours. Remember, neither spouse met the 500-hour test on their own, but together, they are at 550 hours. Those combined hours allows them to satisfy the 500-hour material participation test. 2 different tests, 2 different, completely different spousal rules. I know it gets confusing, guys, but this is it. This you go 1, 2, 3. You write the stuff down and you go, okay, this is how I meet it. For real estate professional status, you do not combine the spouse's hours to reach the 750. For material participation, you get to combine them to meet whatever test you're trying to do. They both worked 50 hours. That's 100 hours. Did anybody else hit 100 hours? No, they're material participants. Mix those rules up and you can either overclaim the deduction or leave legitimate hours sitting on the table. But remember, the test is per property, unless you do test number 3. Are you going to group it? So Mary and Joe are going to be ticked off if they can't deduct the 100K because they didn't do the grouping. So how can we get them to qualify? Well, that's the grouping. That's this next test, test number 3. They can elect to treat all of their interests in real estate as one activity for the purposes of material participation. You actually have to make it on your return. They elect to treat their duplexes, they have 2 of them, as one activity. Now they only need to meet the material participation test as though it was one property. It's one activity. Why does this even matter? Because without the election, you'd have to prove material participation property by property. And there are court cases on this where people did not do that. They would have met it had they made this simple election. They didn't know. The properties can generally be then, we just look at them all together. So let's say you have 5 rentals. You spend 150 hours on rental number 1. It's close to your house. One a little farther away, you spend 125 hours on it. There's a third one a little farther away, it's 100 hours on that one. One even farther away, there's the last 2, you do 75 hours on each. You add that up, you're talking about 525 hours total. Without the election, you would never satisfy the 500-hour test for any individual property. You're not going to meet with a 100-hour test on most of them. But with the valid election, you combine the 525 hours, and it's going to meet the material participation test. Same property, same work, very different tax outcome. But don't confuse grouping with participation. These are separate. Grouping is, I'm adding all my properties together. Material participation is the amount of time you're spending on that activity. The election just combines all the property. It does not create hours out of thin air, and it does not turn an uninvolved owner into an active investor. You still have to meet the material participation test. One taxpayer made the election and still lost because they could not prove that they even materially participated in the combined activity. They made a grouping election and they said, I'm going to group all my properties together, but they couldn't prove an hour. What the election does is it gets everybody to the same starting line. You still have to run the race and meet the material participation test. Now, as a caveat, I'm a tax attorney, so I got to tell you this. Before you make the election, understand what you're giving up. Once you elect to treat all your rental activities as one activity, that's binding. And it's going to be binding in future years. This is not like real estate professional status where it's year by year. This is grouping. I'm treating those activities until you get rid of them. You do not get to combine the properties when it produces a deduction and then separate them when you're selling one property that would somehow give you a better result. So grouping can be incredibly powerful, but it can also affect what happens when you sell an individual property. So you make an election as part of the plan, not as an afterthought. Hey, I can just group it and I'm just going to get this. You got to do your calculations. There's 3 rules to anything tax. Calculate, calculate, calculate. Make sure you're not hurting yourself, because if you group a bunch of properties together and you sell one of those properties, it's part of a combined activity. It's still treated as one activity, so you didn't dispose of that property. So if there's passive losses, they could be trapped for a little while longer. Topic for another day. Everything we've discussed so far applies to traditional rental real estate. And you might be listening going, come on, man, Toby, I don't qualify as a real estate professional. How do I use these losses? Come on. Well, this is where short-term rentals might be different. If the average period of a customer, somebody who's renting from you as an Airbnb, uses it 7 days or less, the activity is not treated as a rental activity under the passive loss regulations. Sounds weird. It's treated as a trade or business at that point. It's a pizza shop. Similar exception may apply when the average stay is 30 days or less and you're providing significant personal services. It's kind of an outlier. I'm not going to dive into that too much, but you're doing more than just renting something to them. Why does this matter? Because you may not need to qualify as a real estate professional at all if that's a trade or business, because the activity is no longer per se passive. So this first test, remember, REP only says, hey, is it per se passive? No. Well, so if we are no longer per se passive, do we need to meet real estate professional? No, but you still have to materially participate. You still have to group those activities. So you do not have to meet the 2-prong 750-hour, 50% or more of your personal service test, but you do still have to meet material participation, and you may have to group those properties depending on what you're doing. But you may be able to use that loss now without hitting this test. This is the one that usually trips people up. So you're a full-time person, you may be able to use the short-term rental loophole. So suppose you own one short-term rental and the average stay, like, hey, I rent it out periodically on Airbnb or VRBO, and the average stay is 5 days. As long as I spend, either I do everything, and I have clients that do this, their spouse will do everything, but let's just say, hey, I have other people cleaning and things like that. I have to do more than 100 hours. Spouses combined, remember, we get to grab them together, and hey, I spent more than 100 hours and nobody else spent more than 100 hours. Wow, that activity is non-passive. And you get to use it. So even though you have a full-time W-2 job and you come nowhere close to meeting real estate professional status, you get to use that loss. And that is why you should never throw short-term rentals and traditional long-term rentals into the same analysis. The average stay matters. The services you provide matters. The material participation matters. It can change everything. So you've got to work with people that know what they're doing. Now let's connect this to real money. Suppose you buy a $2 million apartment building, a multiplex of some sort. Maybe it's a 4-plex, 8-plex, whatever it is. Normally, most of that building is depreciated over 27.5 years. That's the improvement. You never depreciate land, the improvement. Well, there's something called a cost segregation study that breaks that property down into 5-year property, 7-year property, 15-year property, like the land improvements, landscaping, the parking lot, all that stuff. Those are shorter lifespans. The carpet improvements, the cabinets, everything that you put into it, all that stuff qualifies for a shorter lifetime. Landscaping, parking improvements, anything. You combine that with bonus depreciation, which allows you to write off all those items under 20 years immediately, 100%. You can create a massive 6-figure, sometimes 7-figure tax deduction, depends on the type of property. And I'm just going to put a caveat. So a cost seg is breaking that property into its components, and it's usually 30 to 40% of that building you can now write off immediately. If it's things like mobile home parks or RV parks, it could be up to 90%. But you always use a good cost segregation study. You actually need a study. So you need a good cost seg company to do that study. And by the way, I've done a ton of videos with CSA partners they've done over 20,000 reports, hundreds for my clients. And I'll put a couple of those videos there so you can kind of see what a cost seg is. But that's creating a big loss, and that's half the strategy. We've got to create a loss, then we've got to figure out how to use it. So creating the loss, half the strategy. Bonus depreciation, cost seg, you see it all over social media. That's half of it. Now you need to be able to use it. And if that loss is passive, it could be stuck sitting on your return for years as a passive loss carry forward. So cost segregation creates the deduction, which can create a massive loss on paper. You're not really losing the money. But real estate professional status and material participation with grouping may determine whether the deduction actually offsets your active income. And that's the whole reason these rules matter. Here's another trap for people who may qualify after years of owning rentals. Suppose you've accumulated $200,000 of suspended passive losses. Then this year you qualify as a real estate professional and material participate. What happens to the $200,000 of passive loss carry forward that you've been dragging forward? Do you get to use those to offset your wages now magically? No. People think the answer is yes. It is no. The prior losses retain their passive character. Just becoming a real estate professional in 1 year does not unlock those. But those losses can still be used against your other passive income. So they don't just go away, or if you dispose of the property, then it unlocks it. Now suppose that rental generates $40,000 of income this year. You are able to use the old suspended losses against that income. The remaining $160,000, remember we had $200,000 of passive loss carry forward. We just wiped out $40,000. So you subtract the 40 off the 200. We used 40,000 of the suspended loss. Great. So now we have 160,000 of passive loss carry forward. The rest, that becomes usable when you have passive income or when you dispose of the entire interest. So qualifying this year does not automatically unlock every loss against your W-2. Current losses and prior suspended losses do not always receive the same treatment. So maybe you're listening to this then thinking, there is no chance I'm going to qualify, Toby. That does not necessarily mean you receive no deduction. There's another rule that's called active participation that may allow you to avoid these three things entirely. So the rule is basically a $25,000 loss. Certain taxpayers get to deduct up to $25,000 of rental real estate losses against non-passive income without qualifying as a real estate professional. It's called active participation, and it's a much lower standard than material participation. To get it, you generally need, you don't have to have a ton of involvement, you just have to have meaningful involvement with management, like approving the tenants, setting the rental terms with the property manager, maybe approving the repairs from that property manager, authorizing the expenditures, deciding who manages the property. That's usually enough. And you generally must own at least 10% of that activity. But income matters. The $25,000 allowance begins phasing out when modified adjusted gross income exceeds $100,000. And it's like a phase out. I think it's $1 for every $2 above the 100 grand. So the active participation, the 25,000, would then phase out completely at $150,000 of AGI. So you hit 125,000 of AGI, you phased out $1 for every two, so we're 25,000, so we'd lose 12,500 of the 25,000. You'd still get a $12,500 loss. And by the way, this is the same whether you're single or married filing jointly. It's kind of weird. That's that same $25,000, doesn't matter. So if you're single, same number. And there are two other reasons that all these classifications actually matter. So if we're looking at rep status and material participation, it could have an impact on two other areas. The amount of my participation can have an impact on these. The first one is the net investment income tax. That's a 3.8 NIT. You call it the Obama tax. Rental income is subject to the net investment income tax when your income exceeds a certain threshold. So like for married filing jointly, that threshold is $250,000. But real estate professional status plus material participation, do those, and it can eliminate net investment income tax. So the rental activity must generally be non-passive, and it rises to the level of a trade or business, similar to like short-term rentals, right? And you eliminate that 3.8% extra tax. For the folks that are over the threshold, that's a meaningful change. Second, there's a section that gives you the 20% deduction for business activities. It's called Section 199A. Certain rental real estate activities can actually qualify for that 20% deduction against qualified business income. Lowers the amount. Hey, I made $20,000 in rents. I only have to show, what would that be, 16,000 of it. And it's got its own hour test. I know that it's going to drive you crazy. There's a safe harbor with a 250-hour service requirement. Don't mix these standards all together. Real estate professional status, material participation, net investment income tax, how you get away from that, how you qualify for Section 199A. They're all related, but they're different tests. And I know this gets complicated, and that's why you got to work with groups who do this type of work and skip the neighborhood accountants. No offense, but unless you do this type of work, you do not know these rules. Here's the punchline too. There's a state tax surprise. I mentioned it earlier. I promised you in the beginning of the video that I would hit on it. Oh, this sucks. Many states don't follow the same rules as the feds. What? It's already complicated. Yeah, let's just put a mixer in it. You got it. For example, California doesn't follow the federal real estate professional rules in the same way. You can qualify as a real estate professional federally, hit your material participation, do your grouping. You may use that large rental loss against your federal income, and California says, nah, it's still passive. Add on to that, like California also has its own depreciation differences, which can make the state and federal returns diverge even farther. They don't allow bonus depreciation the same way as the feds. They don't accept it. They don't allow it for state tax purposes. So if you're a California resident, you got to calculate your federal tax and your state tax different. Then you have to look at it. And by the way, California is not alone. New York, New Jersey, Massachusetts, and Pennsylvania all have some weird differences as well, right? So you need to model both your state and your federal tax returns. So let's go back to Joe and Mary for an example. Let's just say they live in California and they qualify for that $100,000 in real estate losses as a non-passive loss because they meet the 3 tests. Yes, California can ignore it for state tax purposes, because California doesn't follow bonus depreciation or real estate professional status. So it's just for California's return. I know. That's why you work with people that know this. This is going to scramble the H&R Block brain. You're not going to be doing this stuff on your own. You're not going to use a local accountant. You got to use someone that knows this stuff. You're a real estate investor. You got to work with a group that knows real estate investing. Now, I told you I would get to a mistake that causes most people who actually work the hours to lose. And you've heard some of the cases, right? It comes down to 2 words: bad records. You may legitimately qualify because you put in the time. You materially participated, you made the correct election, you did all this stuff, but you can't prove what you did. You can't prove when you did it and which property it relates to. I'm just telling you, if you don't write it down, it didn't happen, and under audit, the IRS will disallow the loss. So you can always do it. You can claim your hours. Hey, I have 782 hours, but you got to be prepared to show what and back up what those 782 hours were for. Like, what did you do? When did you do it? Was it operational or management work? Was it investor activity? Because that could be separate. Were you working as an employee of somebody else? If you were, did you own more than 5% of the employer company? Was the property a traditional rental or a short-term rental? Because those details determine whether the hours count. So document the date, the activity, what you did, and the approximate amount of time spent. Keep a calendar. Just use your phone if you have to, or email it to yourself. Keep your repair invoices, anything that you did with a contractor, save it. Tenant communications, save them. Property inspection notes, whatever you have, just save it. You don't necessarily need to punch a time clock, but you do need some evidence to back up what you're saying, or the court won't buy it. And don't wait until you receive an audit notice and then attempt to create, 900 hours from memory, right? Just don't do it, just keep it along. If you do that, that's how you end up with the judge calling your records ballpark guesstimate, because they know, everybody knows. All right, so let's put this entire framework together. For traditional rental real estate, test one, you got to meet all three. Test one is real estate professional status, more than 750 hours in half of your working time in a qualifying real estate trade or business. One spouse must independently satisfy that on a joint return. Boom, check that one off. If you qualify, you meet the real estate professional test. So you're 1 out of 3 are down. Test 2 is, did you materially participate on each rental property? And for this one, you combine the participation of both spouses. It's joint. We get to add them up together. And there's 7 ways to qualify, but you only need 1. Check. I materially participated. Oh, but that was if they were one activity. So test 3, grouping. I elect to treat my rental real estate interests. I have a bunch of properties and I treat them as one activity. So you do not have to meet material participation on each property. Rather, you can group them together. That may let you combine all your hours, but the election is generally binding and shouldn't be made casually. Always work with somebody who knows what these waters are. And by the way, let me give you an example. I have 2 properties that are near me that I spend a lot of time on, and I have 10 rentals in Indy. I combine those all. The time that I spend on those 2 is now applied to all 12. And if I qualify as a material participant, fantastic. Even if I have a property manager outside of state, I can combine those all together. Now, last few questions that I would ask depends on the property. Is this a traditional rental or is it a short-term rental? Because that could fall outside of this rule and I wouldn't have to meet the rep status. I just have to materially participate. Other things I might look at is, hey, if I'm looking for a big loss, do I have sufficient basis for that loss? Or did I do a sub 2 and I might not qualify? Am I at risk for that loss? And if I have a ton of losses, does the excess business loss limitation apply? It's really high, but it's there. Can cost segregation help me under these circumstances? Let's say I meet these tests on properties and I'm like, man, I'm going to meet it this year. Should I cost seg those properties and use bonus depreciation, which I can do, even if I bought a property 3 years ago, 4 years ago, 5 years ago, I can still take a big loss this year, but grab it all that I hadn't done and dump it in now. Does it create a big, meaningful deduction? Another thing to look at, do I have old suspended losses? Because if I make a grouping election, gosh, am I going to be losing that loss, am I going to get rid of that property and perhaps unlock that loss? Will NIT apply? Will I get hit with net investment income tax? Is my income enough where I'm getting hit with this stuff? So does this help eliminate that? Would the rental qualify for Section 199A? Like how much, if I tracked my time, would it qualify and could I get a 20% deduction against my rental income? And last but not least, does your state even follow the federal rules? Should we be messing around with this? So real estate professional status can be incredibly powerful, but it's not one test. It's not one election. It's not one box you check on a tax return. It's a stack of rules. And you miss one layer, I just went through 3 of them, you could have a huge deduction that you don't get to actually use. And this is exactly the type of planning we do here at Anderson. We look at your properties, look at your average rental periods, your hours, your spouse's hours, your elections, your cost seg opportunities, your suspended losses, your federal and state returns. We model them both. If you own rental real estate and you are not sure whether you qualify, do not guess. You reach out and you speak to somebody who knows. Here, I'll just offer you a free strategy session. So book a strategy session directly with us and we'll walk you through your specific numbers. I'll leave a link in the show notes. And if you want to attend one of our free one-day tax and asset protection workshops, you can come as my guest. They're absolutely free. We teach them just about every Saturday, and we go over things like your LLCs, land trusts, corporations, taxation, real estate, professional status, estate planning, how to create a loving, caring legacy. You'll walk away with a wealth of knowledge and a good idea of next steps for you. In the meantime, like, subscribe, and share this with anyone who can benefit from this information, and I'll see you in the next one.